Hello, my name is Steve Bigelow with the Candlestick Forum. This week we had kind of a choppy week in the market indexes, which was pretty much evident based upon the candlestick charts of the Dow. Note that on Thursday, the market was trading up, but it opened higher on the Dow and traded lower, only finished up about 35 points. That was evidence that there was some selling in the Dow. At the same time, there was buying in the NASDAQ. Whenever you get inconsistency like this between the two major indexes, more than likely the uptrend will continue as long as you're above the T-line, but it might be a choppy move to the upside. So that's where the T-line becomes a very effective indicator, no matter whether you're trading the indexes or individual stocks. So this week we had some strong sectors setting up: the insurance industry, auto dealers, and retail. Our recommendation on EHTH was based upon this bobble breakout, a very strong J-hook pattern setup that implies that we're heading for the 200-day moving average. So that sector has some good, strong participants. And the retail stocks, HIBB was one of them. Notice it did a J-hook pattern breaking out through this level. And once again, note how the patterns work very effectively. The markets were very bearish or weak on Friday, but you can see how this J-hook pattern continued. So there's three major benefits of a candlestick pattern analysis. One, gives you a high probability of the direction that's going to move. Two, the magnitude of the move is usually much greater than just merely an uptrending stock. Looks like wave 3 could be the same magnitude as wave 1. And three, note what it did on Friday. It traded up positive even though the markets were selling lower. This is another benefit that it's going to continue to move in the right direction, or worst case scenario, if the market really starts selling off, a pattern usually gives you an extra day or two to come out of it before it starts selling off. The auto dealerships, LAD was one of them. You can see the little bullish engulfing gap up through this level, making wave 1, wave 2, wave 3 very viable. We're still long in Blink. You can see the fry pan bottom. Again, very simple T-line rule when you're trading the patterns. As far as the fry pan bottoms, you can stay long as it doesn't close below the T-line. And this is what we call convergence analysis, or 2 plus 2. AVYA, notice the scoop pattern. And then at the breakout level, we had a doji sandwich, which added that much more confirmation that they were breaking out of the handle of the scoop, that there should be a lot more upside. And again, note what it traded, or how it traded on Friday when the markets were selling off. So we can also trade the patterns like a wedge breakout. You can see VVPR broke out nicely on Thursday and continued on Friday. The advantage of this type of patterns recognition is, if you can see the signal, notice our inverted hammer, bullish confirmation, gap up through the resistance level. These are all good indications for the candlestick investor that this wedge breakout is going to occur. So you can watch setups. ARWR has a wedge setting up, and note what happens after this indecisive trading, the ultimate indecisive trading, the doji. Notice how it's right here at the end, which gives you added analysis, meaning we know the doji rule. The price is usually going to move in the direction of how they open after a doji. If it opens positive, you get ready for a wedge breakout to the upside. So it will be important to see how they open the markets on Monday. You want to see the Dow stay up above the T-line as well as the NASDAQ. If it starts trading lower, now you're probably in a downward channel, maybe coming back to the 200. If it trades higher, you still got this Morningstar signal in effect. That'll be it. We'll see you in the chat rooms.